Welcome to the latest edition of Fitch's Virtual Investor Series. I am Paula Moreno, head of North American Structured Finance. Today, as we look to discuss expected performance for structured credit for the remainder of 2023, I am joined by my colleague Derek Miller, head of North American Structured Credit. With 6 months into the year, we are seeing world economic activity holding up better than expected, helped by an easing of earlier adverse supply shocks. But with inflation proving stubborn and labor markets remaining tight, central banks continue to tighten monetary policy. The impact of this tightening on the leveraged loan market still lies ahead and could be amplified by more restrictive bank lending conditions as central banks withdraw liquidity. So jumping right into it, Derek, could you please walk us through what you're seeing has changed or the trends that you're seeing emerging in the CLO market?
Well, when we look at the approximately 800 U.S. broadly syndicated CLOs that we rate, we see some modest deterioration relative to levels last year. Overall, portfolio metrics are about where they were in the first half of 2021 as the markets were somewhat emerging from the coronavirus pandemic or shock. Ultimately, metrics that we're seeing today still aren't back to where they were in the fourth quarter of 2019, but we are seeing some signs of stabilization to some extent. When we look at credit quality in the underlying portfolios, in the last 13 months, 11 of those months have seen more downgrades than upgrades in the underlying assets. In particular, October, November, December of 2022, as well as April and May of 2023 were particularly painful for portfolios. When we look at how that has impacted CLO portfolios, triple C levels across all CLO portfolios is about 7% today. And when we see the difference dispersion in terms of performance, we look at 2018 and 2019 vintage CLOs. Those tend to be underperforming relative to the more recent vintage CLOs. Those CLOs are near the end of the reinvestment period, typically tighter on collateral quality tests and concentration limitations. By one measure, the junior over-collateralization tests, the average for all CLOs that are in our surveillance is about 4% cushion to the junior OC test. When we look at 2018 vintage transactions, they have cushion of about 2%, and 2019 transactions have a cushion of about 3%. Now that's relative to transactions done in 2020 and later that have cushions, more normal cushions of about 5%. When we think about that dispersion, we're seeing some of those older transactions that have weathered a little bit more of the cycle, underperforming relative to newer transactions. And that's important to note as we are in 2023 and we expect to see by the end of this year about 50% of the portfolios exit reinvestment period and by the end of this year. And really those transactions are going to see some amortization come through. By some of the metrics we've looked at, that amortization can vary quite dramatically. On the one end, you can see transactions even from the first half of 2022 that have amortized only about 2% of the liabilities. On the other extreme, you can see CLOs that exited their reinvestment period in the first half of 2022 that have amortized their liabilities by over 20%. Now the differences there are going to be due to manager strategy, cushion on collateral quality tests, and concentration limitations, but in particular, the weighted average life test is going to play a big factor. When we go beyond that, we see transition occurring this year with LIBOR, transitioning away from LIBOR to SOFR. Really, so far what we're seeing on the CLO asset side and on the CLO liability side is a transition as expected. Loans transitioning to SOFR in the second half of the year, and CLO liabilities as well transitioning to term SOFR plus the ARC recommended 26 basis points credit spread adjustment.
Thank you, Derek. And touching on the asset side, what are our expectations for the remainder of 2023 on the leveraged loan default levels?
Let's begin with where we're at today. We're at a 2.6% trailing 12-month default rate on a notional basis in the leveraged loan market. It's obviously lower than that in CLOs since they're managed. When we look at forecasts for defaults, our leveraged loan team is focused on a bottoms-up approach on the underlying borrowers in the market. And so they're identifying stress with those borrowers and forecasting default rates based upon the notional amount. For 2023, we're forecasting a default rate of about 4 to 4.5%. And going forward into 2024, we're forecasting a default rate with a midpoint of 4%. And that's been recently updated to bring forward some of the defaults we thought would occur in 2024 into 2023 as we're seeing more stress move through the system.
Considering this expectation for default, together with the macroeconomic headwinds, what are our expectations for recovery for these assets?
Well, recovery on leveraged loans can be based on a number of factors. But the way that Fitch looks at it is we look at it recovery upon a particular loan based upon the emergence of the borrower from bankruptcy or following a restructuring or distressed debt exchange. We're not focused on the market value. We're focused on that end emergence value to the investor. And that's important because that can vary quite dramatically from market value at various times in the bankruptcy process. Additionally, when we look at recoveries, we're looking at recoveries from all types of defaults. That means bankruptcies, which are often quoted in recovery values, as well as distressed debt exchanges, which tend to have a slightly higher recovery. What we're seeing in the last several years in CLO portfolios in particular is we saw a trend towards an increasing amount of distressed debt exchanges as a proportion of defaults. What we expect to see going forward, certainly for this year, is maybe a heightened level of bankruptcies relative to distressed debt exchanges. And that's really where we're going to see that dispersion of recovery play out and come through in the CLO portfolios as recoveries following bankruptcy tend to be lower than the distressed debt exchange recoveries.
Thank you, Derek. So to wrap up, what do you think are going to be the main drivers of CLO performance for the remainder of the year?
Well, we currently monitor about 1,200 CLO tranches, and we have not downgraded any of those ratings in the last 2 years. We have no ratings on Rating Watch Negative. 99% of those ratings also have a stable outlook. So we feel fairly confident that the cushion to a downgrade in our modeling is sufficient to absorb any future stress that we're forecasting in the portfolios. Additionally, when you think about the way in which CLOs are constructed, they're actively managed portfolios. And the cycle that we're facing today, we've really been seeing the deterioration of the portfolios for quite some time, over a year for the most part. And so CLO managers have been able to reposition portfolios. And as we've experienced in the past, we still expect the average of CLO portfolios to have far lower loss rates relative to the overall leveraged loan market as managers are able to navigate the credit markets and select credits that will perform or will outperform the market in the CLO portfolios.
Thank you for your insights, Derek. And thank you for joining us today for this edition of Fitch's Virtual Investor Series. For more insights on North American structured credit, please visit fitchratings.com. And if you have any questions on any of the topics discussed today, please feel free to send an email to the address on the screen. Thank you for watching.